Good day and welcome to the Phil Barrett Show here at an undisclosed location at the TJM Studios in Saratoga County. I'm here with Jay Thompson. How you doing, Jay?
Hello, folks. How are you?
Good to see you, and great to be with all of you. And we have some great topics to discuss today. And today's topics are going to be basically economics, the markets, interest rates, and all the elements surrounding finances. And we have a great guest coming up. But I first want to just take a moment to thank all of our veterans. We just celebrated Veterans Day. I have the honor of attending a number of very meaningful Veteran Days events, and it's truly an honor to celebrate the service of so many men and women here in Saratoga County that served our country. I also want to thank their families, because when people are deployed overseas or around our country, the families also pay a price, and it's difficult for the entire family. So I do want to thank the families as well as our veterans for everything that they've done, will continue to do for our country. Along those lines, I just want to remind folks of a couple of programs we have in Clifton Park. I'm the Clifton Park Town Supervisor as well as Chairman of the Saratoga County Board of Supervisors. And we have two programs in Clifton Park where you too can celebrate your favorite veteran. We have a walkway at our Veterans Monument on the Common, which is adjacent to the ice arena. And there you can buy an engraved brick for $100 to celebrate your favorite veteran. We also have a banner program, and if you travel around Clifton Park, you may have seen adorning many utility poles within the town. Various veterans whose service is being celebrated as well. So any information that you would like on those two programs, please contact my office at 371-6651, and Gene will point you in the right direction and get you the information you need. Our guest also has a connection to one of those programs, and I want to make sure that I thank him and probably embarrass him here today for his role in helping us celebrate veterans through our banner program. So I want to introduce our guest today. His name is Jack O'Toole. There he is, screen right.
Nice to be with you people.
How you doing, Jack?
Jack, how are you?
I'm great, Jay.
Little information about Jack. He and his wife, Maureen, have been residents of Clifton Park since 1972. Jack spent 50 years with Merrill Lynch in the financial services industry. During his career, he assisted individuals and small business owners with financial planning, portfolio management, and asset allocation. He advised corporate clients, small to mid-sized companies with retirement planning and cash management as well. He attended Adelphi University. He has served on a number of boards in the Capital Region and was one of the founders of the Capital Region Sports Foundation. He was also active in a group that was rather important in Clifton Park, Uncas Booster Club. And he's also one of the original founders of the Shenendehowa Educational Foundation, which is going strong today. And he enjoys traveling, golfing, and promoting the youth of the Capital Region through sports. So thank you, Jack, for being here.
Welcome. Thank you.
Oh, quite the polyvalent background there, Jack.
Oh, I tried.
Yeah, and so Jack has obviously 50 years of experience in the financial services industry, and thought that he would be a great guest to talk about economics, the markets, and everything involved with providing additional information to you that might be helpful when you're making financial decisions. But going back to the Veterans Banner program, when Jack heard that this program was underway in the town of Clifton Park, he stopped by my office and said, you know, there might be some veterans who might need some financial assistance in celebrating their service through the Banner program. And he stopped by and said he wanted to donate a few banners, which was just an incredibly generous offer.
Philanthropy as well to add to the list.
Yeah, absolutely. And then after we had presented those banners to a few veterans, he came back and said, Phil, how about I donate another 8? So thousands of dollars
Thank you.
donated by Jack to the program. And just the other night, we were able to jointly present a banner to a young man, 104 years young.
Wow.
105, December 31st.
Yeah, he's coming up on 105.
This guy's one of the oldest people, right? What's the oldest person in the United States?
120 something.
120?
Yep.
Well, he's got a ways to go, I guess.
Well, it gives you something to shoot for.
My dad's something to shoot.
So the gentleman, 104 years
Amazing.
young, and I called Jack and said, I was invited to this event. They're honoring this veteran, 104 years old. What do you think? And he said, absolutely. We kept it a surprise, working with our friends at Coburg Village. So we surprised them with a brand new banner, and we unfurled it. And obviously, the gentleman was very touched with the whole thing. So I just wanted to thank you, Jack, very much.
Great. So appreciate it. Anything for our veterans is more important than anything we can do.
Yeah, why is the program? What touched you about this program in particular that you really wanted to get involved?
I want to make sure the generations to come understand that it wasn't them at their time in their life, that there are people who built the foundation before them that allows them to have the life that they're going to have.
Yeah.
And there's no better way of doing that than by showing off the people who put the time and the effort in, who sacrificed in order to make this country as great as it is.
Yeah, well, God bless you. Thank you so much, and thank you again for helping us with that program. It's really caught on. We have dozens of banners up. We get inquiries almost every day from folks that want to be a part of it. So again, you can call my office at 371-6651, and Gene will put you in the right direction. So as we talk about finances with Jack and Jay,
Jack and Jay.
I'm sure Jay's got something to offer here too as a small businessman, and among other attributes that he has. But we're not going to get into any stock picks, but instead provide information for you to use when considering financial decisions. We'll start with some very basic ideas, some basic questions, and then we'll move to things that are a little more involved. But again, the idea is to try to give you a little more information to think about. Maybe you'll learn something through this podcast that will help you then decide your next steps with borrowing money, investing money, and any other financial decisions that you may need to make in the near future. And of course, we're always making those decisions on a daily basis. But I think the very first question, Jack, that I get asked quite a bit is, I want to get an account, whether it's Merrill Lynch or Fidelity or whatever it might be, and I guess I put money in there and I can buy stocks and stuff, but where does the money go?
Okay, well, let's kind of start at the beginning. When first companies decided they needed to raise capital for, if Jay's business was at a certain point, he wanted to raise capital, more employees, expand, et cetera, he needed to sell part of that company, and you do that in the form of a stock or equity position. So when it first happens, there's two parts to this that take effect. The first part of that is going into the primary market where they provide you with what they call an IPO. Mm-hmm. Okay, and this IPO is money that is being raised by the company. Again, we'll use Jay as an example. So when you and I buy in an IPO, that is the primary market. That's the first market. We pay our money directly to Jay and his company, who then uses that money, as I said, to expand and do whatever he needs to reach the capital markets. Now, once that happens, that IPO gets set by Jay's company, as an example again, and also with an investment banker who decides how many shares they want to issue, mm-hmm. the amount they're going to charge for these shares, et cetera. Now, once that is all complete, yes.
No, go ahead.
Okay.
I'll let you finish your train of thought.
Okay. Well, once that part is complete, it now reaches the secondary market. The secondary market is what everybody usually associates the markets. It's the New York Stock Exchange. It's the American Stock Exchange. It's the NASDAQ, any of those kind of companies. At that point in time, any transactions that happen is if I'm buying a security, I'm buying it and paying my money to the seller. And that's done through a brokerage account. And again, the idea behind a brokerage account is you deposit your money, you work with an intermediary who puts the buyer and the seller together, and any money that you're putting into that account, you're putting as collateral for that piece of paper that you're going to buy and your ownership into that business.
Yeah, and an IPO is an initial public offering, and we always talk about wanting to be on the ground floor. And if you're in a position of owning a company, or maybe you're a private investor in a company that then has an initial public offering, you're in line to make a whole pile of money, because that company is going public, and that initial public offering, all that money comes to the company. And as Jack mentioned, then everything goes to the secondary market. The secondary market is when you're basically buying a stock that's on the New York Stock Exchange or the NASDAQ or what various exchanges, and you're buying what somebody is selling. So you're buying a stock that somebody is selling. You obviously want to buy as low as possible and sell as high as possible. Buy low, sell high, and that's how you make money. Jay, did you have a question?
Yes, the question I have is when an IPO first gets put out there, who establishes the opening price point and also the number of shares for that company?
There's a meeting that happens between the business owner who wants to bring his company public, and they go out and hire an investment banking organization. It might be a Merrill Lynch, it might be a Goldman Sachs. Together they sit down, review the business, review the projections of what the business owner thinks is going to happen. They put all of that together, and they say, well, we believe a fair price for the public to be buying is X, what, $15 a share, $20 a share. Now, and they set the amount of shares that are going to happen. Usually, if it's a small business, it's going to be something like they call small cap stocks. That's going to be something on the order of probably $1 billion to $2 billion in total issue of monies. It can be a lot less than that, and it can be more than that. But generally speaking, that money gets issued by the investment bankers, and it's then brought to the market through the intermediaries. So you would then go to your brokerage account. You're buying an IPO, your investment, and then that money, then you're paying whatever dictated price. So it's $15 a share, and you buy 100 shares. It's $1,500. Now that goes public. The price can go down or the price can go up, because now once that happens, it's transferred to the secondary market, and now market makers are making a decision on how that's going to go based on what they see coming in. Now, as our superintendent mentioned before, once that goes public, there's either demand or not a demand for those companies. So you can make a lot of money if there's only 1 million shares being issued, and there's a demand for 2 million shares, and then the price is going to go up.
Sure.
So if you go out, if you have an IPO and say the number is set at $15 a share, and you own a lot of those shares because you're part of that initial public offering, and that the price of the stock ends up going to 40 in a few months, well, you made even more money because the value of your investment has grown exponentially. Longer term, who knows? Could go up or down, but that's the general idea. But I do get that question quite a bit. Where does my money go once I buy that stock? Where does it go?
Well,
and how does it work?
Easiest thing, if you're buying it, it's never been public, you're paying the company directly. Once that's finished, whoever's selling you the stock, you're paying them directly.
I see the wheels turning. I think Jay's thinking, how do I do an IPO now? Is that what you're thinking, Jay? Are you ready for an IPO?
Me?
Yeah.
Unfortunately, it is super expensive to start an IPO. It's crazy money.
Yeah, it is. Well, I think you should start by getting some private investors. I'm sure Connors will put in at least 50 or 100 grand, and then you tell everybody Connors gave me 50 or 100 grand, then everybody will pile in.
Yeah, but then I got to have you responsible to Jeremy Connors.
Well, yeah, then you have to report to him on your, you'd have to give him quarterly updates on your finances. So yeah, in effect, he'd become a partner. I'm not.
Can you imagine that?
I'm not sure you want that, but One thing that's been on the minds of folks over the last few years, and I think played a big factor in the election, was inflation. So, what causes inflation? Inflation is when you have too much money chasing too few goods. I mean, that's in basic terms, that's what causes inflation. Of course, you have many other factors. A big one is governmental spending. And when you saw all of that money spent during COVID and then after COVID, you saw like the Inflation Reduction Act, which was
Inflation Increasing Act.
yeah, exactly.
Spend more money.
Most ridiculous name you could place on something where they're spending, I think it was $500 billion. So basically, that was just putting gas on the fire because government spending typically, especially by those amounts that we're talking trillions of dollars, are going to be inflationary. And yes, the government's always coming out with new statistics on inflation. Yeah, you can pay attention to those statistics to a certain point, but I think it's more important to understand what you're feeling and what you're experiencing instead of letting somebody else tell you what the reality is. When people were going to the store, when they were buying things, they saw that prices were going up dramatically, and then you might come home and you see all this news, comments from the Fed and Janet Yellen and others talking about, well, it's just transitory.
Janet Yellen.
Transitory. Remember, transitory became part of our lexicon. All this new inflation is transitory. Don't worry about it. Transitory basically meaning it'll be quick, it'll pass, it'll peak a little bit, then it'll go down, it'll go away. And that day, when they started talking about transitory, I loaded up on a bunch of stocks that would benefit from inflation because I knew damn well that was a ridiculous statement. But from your standpoint, Jack, when it comes to inflation, what are the major factors that you see, maybe in addition to what I've already mentioned, and how do you see the trend going with inflation in the near future here?
Well, I look at the number of things that go into effect when you're starting to look at portfolios and managing people's monies. You're all looking at the high consumer rates. Now, again, when cheap money was provided, everybody received cash or was able to borrow cash at zero rates, so they decided to go out and continue to buy. Once they did that, they created a shortage. Mm-hmm. So once you created the shortage, you have a market disruption because there's no supply side. So you had 5 or 6 different areas that all stemmed from the fiscal stimulus. Now, once that happened and blew us up to rates we hadn't seen in decades, there now becomes another problem. The other problem is, how do we stem that? To the other part of your question, how do we stem that and bring this back down again?
Right.
Which then means you have to raise interest rates. Right. The more you raise interest rates, the less likely it is for somebody to go out and continue to buy. Now, what happened to us in the 2 or 3 year time frame in the past year now is, even though rates went up, people continued to buy. So they continued to raise rates until it got to be the choking point, which is now starting on the way down. So, the answer to your question, what happens now? We've seen rates come down. Mm-hmm. We continue to see rates come down. The Fed is in a cutting mode, and they're basing that on the fact that there has been some supply chain. I would probably ask him about what he sees in his business, but generally speaking, we're seeing supply chains have been changed. Mm-hmm. We've been walking away from some of these areas, some of these countries, some of these entities that are not as favorable from an economic as well as a political standpoint. That started to mellow a little bit. From that point then, what will we see the Fed doing? And I always base everything that I look off have always based it off of what Fed funds rates are. What are Fed fund rates? Fed funds rates are what the extra money a bank has that they put on deposit with the Fed and get paid an interest rate. So these banks can transfer and move their monies as well as lend monies out.
Right.
The higher that is, the less likelihood they're going to lend anything, the more the banks are going to charge on your credit cards, on your ability to buy a car, and so forth. Well, the Fed sees an easing coming in, and they start to drop their rates. Currently, we're in the Fed fund rates are currently around the 4.75% to 5%. Probably by the end of the year, we'll see that down to 4.5% to 4.75%. As we get through 25 into 26, we'll probably see in the mid 3 to 3.5 range for 25, and then down to something which is normal around the 2% rate. So we should see inflation continue to trend down. The problem is the economy is changing directions from what we are all used to.
Those numbers and metrics don't necessarily apply today.
Correct. And the reason it doesn't is we're in the next big phase of technology, AI.
AI.
And the problem that presents is it's an energy source.
That's why Trump's drill, baby, drill.
Yeah.
We
it's
need
an-
to lower the cost of energy.
And the problem that's going to create is you've already seen it with companies like Amazon and Google. They're out there contracting with companies to build nuclear generators.
Yeah.
Yeah.
Microsoft just came out, wants to fire up 3 Mile Island.
Right. Well, and the problem, what we're seeing here then is we have an inflation rate that's coming down for certain things that'll be good for us,
Sure.
but other areas that will probably continue to trend upwards. So,
Well, at the end of the day, the government's still got to pull that money back in. That's the only way they can do it is to keep interest
but the
rates.
hardest thing to do is going to try to be able to getting back down to their target 2%.
Yeah.
They may be stuck for a while in this 2.5% to 2.6% range. So again, there's a lot of other factors to answer your question, Phil, that are eating around the edges. And again, shock to the economy. The lower end of wage earners are demanding more money just to live. That's all aiding out, but we're going to have some energy decisions to make in the next. And by the way, building those plants doesn't happen in a year or two. It's a decade or
You
more.
have 7 years
Yeah.
of permits just
Yeah.
to.
Well, it's interesting. I had that on my list here because it's interesting talking about the future of energy and how that's going to play out. And the big money companies, you know, the Amazons, the Microsofts, the Googles, they're all coming around to nuclear. And there's an incredible undercurrent of new technologies that are coming on board. Companies like Oklo and SMR, which you can buy on the stock exchange. Excuse me. And these are nuclear stocks, and right now they're startups, so they're very risky. They're not making money, far from it. But there's the promise of this burgeoning new technology coming. That I was also reading about a company who is going to install nuclear, and I'm not sure how it's going to look or what it's going to encompass, but they're going to put nuclear energy equipment a mile below the Earth.
That one, I haven't heard about that.
I think it was deep.
Encapsulate it, yeah.
I think it was deep fission, but they're going to put nuclear a mile below the Earth, and the idea is to have nuclear pods that would power these huge information centers that Amazon, Google, and everything, they're all setting up for AI. And they want to use nuclear and have their own power source through nuclear encapsulated somehow within their operation. So incredible new technology. And you're going to be reading more and more about that in the future. But there's a lot of those new companies coming online, and those are investment opportunities, but very risky. So that's something to keep in mind. But I think with the new government efficiency initiative that President Trump has undertaken with Vivek Ramaswamy and Elon Musk is going to be very interesting because the amount of government waste is just off the charts.
It'll be interesting to see what happens over the course of the next couple of months. I mean, they have already made overtures to China and some of the Asian markets that sell us some of these products because we lack some of the things that are needed in some of this AI technology. And it has been sold off and dissipated through misuse. So it'll be interesting to see what happens over the next couple of months. That's
Yeah. So that gives you an idea of where we think inflation's going. Generally, right now, the Fed interest rate, which is a benchmark, it's the prime rate, which is
prime rate is separate from the Fed rate.
well, it's set by the Fed.
No, the Fed funds rate
Yes.
is the rate to lend interbanks. The banks then, depending on what they borrow off the Fed or get paid off the Fed on deposit,
Right.
then determine how they're going to set their rates, which
But they coincide. So
Yeah.
when the Fed cuts the rate by a half, you'll see the prime rate come down a half. And
depends.
yeah, because it just came down another 1/4%.
Right.
When the Fed cut the interest rate by 1/4%.
So what
But that's important because a lot of people have loans, could be home equity loans or business loans in particular, where you have a line of credit that is targeted at prime plus, could be prime plus 0, prime plus 1, 2, 3%. So when you have that prime rate at 7.75 as it is now, and say you have a prime plus 1, that's 8.75%. And so that's something that certainly affects people's decisions, whether it be investing in their business, going out and taking risk, which is a very important part of our economy. I think if you have a loan at prime plus 0 and the prime rate's at 4, that's a much easier decision than prime being at 7.75. So that's been definitely a detriment to the economy and investment.
From a businessman standpoint, that's for sure.
Yeah.
what governmental policy affects short-term credit card interest rates?
The Fed funds rate.
Because if you look at some credit cards right now, 20, 30%.
Well, again, there's a bank discretion. Once the Fed funds rate, again, banks.
Because that affects more people than for argument's sake, fixed loan.
See, it used to be when in 2020 this changed. It used to be that the excess cash that a bank had was deposited in their account at the Fed.
Yeah.
At a Fed, one of the Fed banks.
Depository, sure.
So that changed in 2020. Now these major banks move so many trillions of dollars at a time. That act was removed, and so what they do is excess money is deposited, and if Bank A needs more money, it borrows from Bank B, and the rate that they're paying to borrow is what the Fed fund rate is. Now again, it's still pretty high at that 4.75% to 5%.
Yeah, when you're talking billions of dollars.
Yeah. So to Phil's point, they're gonna then push that out to anybody else, be it credit cards, be it mortgages, be it lending to business, et cetera. So the more that comes down, and again, probably within a couple of years, as I said, we'll be down back in the 2% range. That will affect that. But the banks do have their discretion to not charge 20% or more or less.
Or less.
But
A lot of that's factored into their losses too. I mean, they certainly. I'm not saying they have to be 20% or 25% or whatever some of these places charge, but there's a lot of things factored in there. It's the cost of money, which all the banks obviously take into account when they post their loan rates, but also there's the cost of doing business, and a lot of that is the losses that they're taking on the debt.
You've just hit on a point that's important, because the cost of doing business, when a financial institution is depositing at the Fed, they have to take into account what money they pay in their savings accounts, what they pay in their high savings accounts, what they pay in their CDs, and that depends on who they can lend money to and how much they can charge to lend money to bring all of that in. So the less expensive it is for them, again, through the Fed funds rate, the better it is for you and I as the consumers on the other end of that.
So everything's a double-edged sword. So
Correct.
you want that high yield savings account, but you're going to pay through it with your high credit card interest rates.
Well, as we've seen over the number of
If you
years
think
with
about it.
zero interest rates,
Yeah.
our deposits weren't paying anything.
Correct. All right. That's a good explanation right there.
Yeah, and in recent years, you were able to get a 30-day CD at 5% or more.
Yeah.
But interest rates overall are much higher. So yeah, it all depends on your investing decisions, and that's an important topic, Jack, because when the stock market goes up, like it has since the election, it's in the news every day, it's in everybody's discussions, but there's a lot of people that aren't in yet, right? So they say, "Oh gosh, I missed the upside again. I missed the opportunity." And if we all knew when the lowest point of stock would be, or the stock market would be, and where it was going, we'd all be rich, right? So
Or wouldn't have sold.
yeah, right. So there's no perfect entry point. There's no perfect exit point. At least looking ahead, maybe in the rearview mirror. So, what is the best way if somebody said, "Well, gee, I really have a lot of confidence in the economy. I do have some extra money I can put at risk because it is a risk going into the stock market." What's the best way for people to get started?
Okay, so you just hit on when I would sit down with a person or business, the first thing we determine is what is it your goal that you're trying to get to? Am I trying to retire at 55? Do I want to have monies that independently give me enough cash to live the life that I wanted? All those kind of things are taken into account. Now, once you've done that, you accumulate, I used to like to say, 6 months of living expenses, and you take that out of the equation. Once you take that out of the equation, it's not the timing of the market, it's the time in the market.
Right.
As an example, people talk about precious metals, things like gold, and you see advertisements constantly on TV. If you go back to 1990, January of 1993, the spot price of gold was approximately $450 an ounce. Okay? The spot price of gold as of the beginning of this month was about $2,700 a month, give or take. So again, you would have made a lot of money. The problem here is gold doesn't pay anything. So if you need to access any of that, you need to sell it. Now compare that to the equity markets. In this case, let's take the Standard & Poor's 500. If you go back to that same time frame, you were roughly about 500 or thereabouts, 600 for the S&P 500, and we're in the 6,000 range now.
Yeah.
Now the difference between that is that's a return over that time frame of about 12.5% a year, with the income that those companies in the 500 produced, as well as the appreciation of those companies. The difference here now is you can take your S&P 500 and you can break it out to reinvest or take the cash flow. So to answer your question is, are you going to be in this? And if you can't see a horizon of 3 to 5 years that you're going to have this money at risk, as you said, then you're probably not a person that needs to be investing. This afternoon at 2 o'clock in the afternoon could be the time to start. Tomorrow morning at 9 a.m. could be the time to start.
Right.
It's the timing in the market and diversity for beginners. Diversity is the S&P 500. Diversity is the NASDAQ, the QQQ, the top 100 companies. Diversity is the Dow 30. As long as you don't have all your eggs in one basket, you're diversified. And you usually do that through an index. You can do that through an actual mutual fund, or you can do that through an exchange traded fund. Diversify your assets, put your money in, reinvest your dividends, compound it, and you'll do fine over the
Because
long
and that's a good point too. You don't have to buy individual companies. You can buy a basket of companies through an exchange traded fund, for instance, where you can.
Vanguard or something like that.
Well, there's a
there's
myriad of companies.
a million of them. Yeah.
Just because people know.
BlackRock,
I've heard it.
Vanguard.
Whoa,
Yeah.
whoa, with the BlackRock there. Evil company. So is Vanguard.
But yeah, so you can buy a basket of stocks through a stock. You could call it a stock that you're buying, but you're buying diversification. Or you can buy individual stocks and diversify your portfolio that way. What you were talking about, Jack, was the appreciation in the income, and the income comes in the form of dividends.
Dividends, correct.
And dividends are something that not all companies. Some pay dividends, some don't. And what you want to do, if you look on any number of finance websites where you can check stock prices, you want to look and see where it says yield. Typically, it'll say yield as the moniker, and that will and it'll have a percentage. Could be 0, could be 8%, and it does fluctuate with the price of the stock too. But you can find some very strong companies that pay a dividend. So every quarter of the year, depending on the amount of shares you have, in relation to the level of dividend at that time, the percentage, that will be money that comes to you. Now, you can take that in the form of, you can have it automatically deposited into your account. What I would recommend doing is having it reinvest back into the stock. So, in other words, you can set it up on your profile that when your dividends come in quarterly on a stock, you automatically buy new shares of stock, and that helps you compound. And as Jack said, time is your friend. That helps you compound the number of shares. It's money you're not going to miss. You just don't think about it. It's just happens automatically. So that's a way to also grow your money over time.
But dividends can also be a red herring, though, because typically the more volatile the stock is, the higher the dividend pay is. I've noticed that some of that, because I'm a huge dividend stock guy, I love dividends. But I noticed the ones with the higher, if you get past 10% dividends, those stocks are so volatile and they're all over the place.
Well, usually that means there's a risk.
Yeah,
To the,
yeah, because they're enticing you to buy it.
Yeah.
Well,
again,
with the dividend and.
It would, well, a good example would be people own General Electric, and General Electric at one time was a 10% plus yield. Well, what do? They slashed the dividend and broke the company up in three different spots. So there, what you're looking at is a company that's a controlled or one or two in their marketplace who has a history of increasing their dividends year in and year out. If everybody looked around their house, they'd probably find 10 to 15 products that are owned by a company called
Like Procter and Gamble. Yeah.
Okay, so and if you look at the dividend yield of
3-4%.
Procter and Gamble,
Yeah.
they have increased their dividend every year for the last 45 years.
That's one of the stocks I own, actually.
So there you go. So I mean, there's you can take your, if you're going to look at individual companies, and as a beginner, I would not look at individual companies. I would look at
S&P 500.
yeah,
Or
and I would look at bigger name companies too. I wouldn't look at the small, mid-sized companies because they tend to, like you mentioned before, they tend to be more volatile. I would look at the bigger name companies, the companies that we normally associate with the Microsofts and the IBMs and the Procter and Gambles and all those kinds of companies in one of those exchange traded type funds.
So the funny thing is with the dividend, a little anecdotal story, is I have a stock in my portfolio called IVR. It's a management company, and their dividend is 30%, and I'll get like $200 every quarter from that company on a $2,000 investment. But that stock has perpetually in the last 5 years I've owned it has gone down and down and down. But that dividend is always I made more money than the money I originally invested just in the dividend. But eventually there's going to be a point of no return, and I got to pull my money out of it.
The key is if they cut the dividends.
Yeah.
So usually when there are stocks that pay a high dividend, especially those that aren't a Procter and Gamble, some company that's much smaller, if they ever announce that they're cutting the dividend
That's when you
because
pull
they're
out.
having financial issues, the stock will tank.
Yes,
Typically. I have an oil tanker stock that pays about a 25% dividend, which has been good. Their results have been good, and that's one of the ones I bought back in the transitory period when that was coming about. But they can be risky. And again, the other thing I tell people is if the stock market drops 5 or 10% and you can't sleep at night, it's probably not the place for you. So that's the other thing. You don't want, if you're so risk averse that a drop in the market is going to keep you up at night and really affect you in that way, it might be better that you don't invest in the market.
Stick to bonds.
Because it's going to
Look,
it's going to go up and it's going to go
I
down.
know, but
Yeah.
typically they're a lot more.
Yeah, inflation kills the value of
Yeah.
your purchase.
But you don't lose your
fixed income.
original money, though.
Yeah.
Well,
you're right.
on the-
You're right, though. You really can't be risk averse and look at it every single day if you're going to invest in the market. 'Cause
Well, you
it's-
can look at it every day, but if it's going to destroy your day, I'm not saying you have to be happy about it if your stocks went down, but if it's just going to really put you in a bad place That's something you have to think about as you go in. But, you brought up bonds, and Jack, when it comes to bonds, there's high yield bonds. So, there's government security bonds, which are typically less volatile. But getting a little more into that type of thing, what would you suggest people think about when it comes to bonds, if that was something they were interested in?
Okay, first of all, you have to take it in my opinion, you have to take into account when you're buying a fixed income bonds, what you think you're going to be seeing for inflation over a number of years. Okay, so that means you start off with the simplest things. You pull out any of the cash that's in your pocket, and you look on it, it says bill. So there's treasury bills, and that's cash. That's the dollar bills that we have in our pocket. Then there's treasury notes. Then there's treasury bonds. Treasury notes go from 2 to 10 years. Bonds are beyond that. The theory is the longer out you go, the better or the higher the rate of return is. But it hasn't been that since that point in time, since the fiasco back in '08. Now they call it the inverted yield curve. From there, you go to corporate bonds. A corporate bond is something that an IBM would issue to the public. And again, those yields tend to be higher than government bonds. We won't even bother with the tax exempts because that's another status altogether. But now, when you get to the corporate entity, you're then talking about the highest quality, which is AAA, AA, A, triple B, double B, B. When you get below anything below a triple B, it's no longer considered an investment in quality. It's considered investments in higher risk investments. So when, Phil, you mentioned high yield bonds, there's a reason they're high yield. They may be small to mid-sized businesses who don't have access to capital, and they can't get access to a bank, so they hire an intermediary who lends them the money and issues the bonds, and that's why you get 8-10% returns on some of those investment choices. Doesn't mean they're bad, but when you're buying those, you're sure better off looking at something that's like a mutual fund, because theoretically the analysts who take care of that know there's going to be some amount of failures and will negate that as much as they can. So buying a high yield bond, you're taking on a lot of risk.
Right.
I, again, selfishly have been a person who looks at fixed income I like to see 5 to 7 years as a maximum maturity. Why? Because I think inflation eats the purchasing power. That's a personal choice by me. I realize people like to be out further. But if you look at the 30-year bond, U.S. government bonds now, and compare that to the 10-year government bonds, there's no difference.
Yeah.
So why would you take a 10-year investment and lock it in for another 20 years for the same rate of return?
Because you could always re-up it.
Yeah.
Yeah.
Sure. And it could be higher, it could be lower. The second part of that fill-in is in terms of fixed income and what you're doing, you can ladder those bonds. By that I mean is you have $1, so you put 25 cents in 1 year, 25 cents in 2 years, the 3 year and 4 year. Now, why would you do that? Well, you do that because maybe interest rates are going to go up. So the first year that it matured, you move it back to the fourth end. You're getting a higher rate of return.
Right.
If the rates had gone down at the end of that 1 year, you're not going to lose that much income. So if you're laddering something that's going 2 to 5 or 2 to 7 years, you're taking advantage of spreading your risk and return or your coupon over a longer period of time. And only, depending on how many years you're doing this, only 10 or 15% of your portfolio is subject to return risk, that is coupon risk.
And a lot of people do that with CDs. If you had $25,000 and you wanted to put it in a certificate of deposit, a lot of people will do that. They'll put, $5,000 in a 30-day, $5,000 in a 90-day, $5,000 in a year, on. And that way, they always have money that's coming available to them. Maybe they need it for a personal expense, or they want to reinvest it in another opportunity. So laddering, instead of taking $25,000 and just putting it into one product, laddering your investment can help give you more flexibility over time. So that's a very good point.
I'm glad you explained that, because I've heard that term before, and I really wasn't quite sure, could never understand what it meant. But I'm glad that you've explained it really well. It makes total sense.
Yeah. Well, maybe let's add a little bit of wrinkle into the fixed income. When you own a common stock, you're the last in line if that business goes out. The banks, the lending institutions are first, then the bondholders, and then the preferred stockholders. Preferred stock pays generally a little less in a coupon than you get on a bond, but certainly pays more than it does on common stock. The only reason you'd be buying preferred is because you're getting paid more, and because you have the opportunity, more so in liquidity, to be able to sell it on a market on the secondary market, as opposed to what you have to go through selling a bond. The problem is when you buy a preferred, is you have to look at maturity. Some of these preferreds are issued for 100 years, so you buy something that's paying 8%, and all of a sudden you're 6 or 7 years out, and the rates are now 10%.
Yeah.
You're losing.
You really don't have it.
No.
It's a fixed income vehicle that becomes a 100-year investment, and I don't know how many of us are going to be around another 100 years. But
Why would you want an investment like that?
well, institutions like insurance companies and such, they have to match up their obligations to returns over a certain period of time.
Okay.
So they'll be any major institution, a pension plan, that defined benefit pension plan knows they have to pay out a certain amount of money, might start matching up the assets that they need against the liabilities that they're going to have to pay out in the future. So that's where you find most of those big institutions buying those things.
And I think going back to what we were talking about, when to get into the market, there's no perfect entry point, there's no perfect exit point. But the best thing to do for most people, especially if they're brand new, is dollar cost averaging, right, Jack?
Absolutely.
Where you want to start at a certain level. The first step is to open your account. The second step is to understand and set how much money you'd be able to put into that account weekly, bi-weekly, monthly, whatever you choose. And you buy stock in small amounts each month. And that's called dollar cost averaging.
Well, let me add a little bit to that. Probably when you're sitting down to review how you want to do this, one of the things you should discuss with your financial advisor is, how will I do this? Am I doing this on an after-tax basis or a pre-tax basis?
Yeah.
What do I mean by that? Well, if I'm a teacher, I can be putting money in my 403B. If I'm in a business, I can be putting my money away in a 401k. Now, that's all pre-tax investments. So if you're going to spend $100, $200, $300 a month and do the dollar cost averaging, and you know that's going to happen, wouldn't it be better to do that on a pre-tax basis? And generally speaking, if you're in the business, if it's a 401k as an example, generally speaking, the business that you work with is probably going to match some of that money you're going to put in.
Mm-hmm.
So if you're putting in 5% of your salary, and the company is going to match that 5%, you put away double the amount of money.
Yeah.
That adds up pretty quickly over a period of time. And if you want to figure out what the value of your money could possibly be in the future, there's a formula that's called the theory of doubling your money. And it's whatever the rate of return you get, it divided into 72.
Mm-hmm.
So if you say you're going to average 7% rate of return, approximately 10 years out, you're going to double your money.
Yeah.
So pre-tax or after tax. Now, again, it brings up another question, though. If you're doing it pre-tax and you have to access money because you're going to buy a house or there's an emergency and you have to take money out, there could be penalties to do that. So you have to balance what's best for you. So go back to what we said before, understanding your risk, understanding where you're trying to get to. Generally speaking, you're better off doing pre-tax.
And you're better off starting small and investing in increments. So that way you're spreading your risk. But it's important, again, time being your friend, the longer you do that and the longer you stay in the market, but on a historical basis, the much better off you will be. Jack, do you get into Bitcoin at all? Is that something you follow? I mean, it's up $20,000 since the election. It's up around $90,000 on it now.
Well, let's go back and talk about just what that is. It started in 2008. That was when it was created, and it's generally considered to be one or two guys that have put this together. Okay, now. It can be used for a variety of things. It can be used to pay. It can be used to receive. It can be used to contrast with other forms. The idea behind that was not to have a bank or a government controlling how you were spending your cash and such. The marketplace is determining whether or not that's a value or not a value. If it goes up, then your cash that you put in there is worth more money. If it goes down, as it did, then people lost a lot of money. So let's kind of go back. If you give me a second here, I'll go over the process. It's simple, but it's complicated.
Yeah.
Okay, so let's kind of do this in a way that makes a little sense. I told you it started in 2008, and it's a cryptocurrency, and it's all based on blockchain. In the beginning, nobody wanted to do this at all. They all thought the major banks, presidents all poo-pooed it, et cetera. Except
Right.
now, the real value that's come out of this, and Bitcoin it's obviously a particular blockchain, but it's also that it's kind of like Zoom calls. Okay, there's 5 or 6 different companies that do it, but they're called Zoom calls.
It's a Kleenex of tissue.
Yes.
There you go.
Correct. Correct.
I guess I have to use that analogy.
Branding.
So if we take Bitcoin, it's in the form of what they call a blockchain. And a blockchain, the idea behind that it used to be in my environment when I started off, when you bought or sold a security, it was trade date plus 7. That meant that you sold it today, and 7 days later you got your money. And for technology took over, it came down, it came down, it came down. So now it's trade date, and you get your money the next day. And the reason that's happened is because of blockchain, which is a derivative of what put Bitcoin on the map. Okay, so the next question is, what's blockchain? The idea behind the blockchain is there's a whole bunch of different things that make up this blockchain. It's the software that goes into the account. It's the hashtag that you see on there, and I'll talk about what that hashtag does for you. It's the Merkle root. Okay, the Merkle root is the single hashtag that encrypts the information that sends it out. There's a part of this that's probably the hardest thing for people to understand is why are all these people mining these encoding? Well, they're doing it because every time you add a hashtag or every time you put add a factor to that, you get paid in these coins to do that. Okay. By the way, that was up until AI came out. This mining of Bitcoins or mining of these coins was chewing up energy even faster.
Yeah.
Just say energy right there.
Yeah.
So okay. So in that also in that blockchain, you also have the timestamp, and the timestamp is when it happened, the time it happened, the day it happened, everything you need to know about that, and the difficulty target is again. I'm mining. I'm looking for my hashtag. The difficulty and the problem to where I can find the next block that I can add in the chain to get paid. And then there's the nunci, okay? That's the numbers used. So everything is based on a hashtag. And what makes blockchain so superior to other types of transactions is you cannot go in and decide that you're going to change any one of these blockchains, because if you do, it changes it.
They're all locked. They're interlocked.
It changes all the way back to the very first
Yeah.
one.
Mm-hmm.
So therein lies the complication. So what these people who are mining have to do, by the way, it's all encrypted. Okay, when it happens. But if you're mining or you go in to look at that, everybody can see what all those blockchains are, what all those hashtags are. So it's not hidden; it's there. You just have to make sure that you're not spending your energy looking for something that's already there.
Right.
So the idea behind that is, what's the value use going to be? What can they get to? And once you get 210,000 blockchains, they hash it or they cut in half the bitcoins you get. So in the beginning you got 50, then it's 25. Now they're saying by 2030, when you add a blockchain on there, you're going to get paid like 1.5 bitcoins. So it's a race to the end here to see where the value is going to be. Okay, now there are people who have. There's one guy who's on his last. He has only one chance left to enter his correct password. He doesn't know what it
he
is.
still hasn't gotten in his freaking vault yet.
Nope.
Oh, he's got millions and millions at stake. Holy
No, no,
crap!
Better stated, he's got billions. At stake.
Billions. Well, I'm sure it's gone up. I
And
mean,
once that
it's-
locks out, you're
yeah.
done.
Well, that's the thing. It's so abstract and it's so difficult to explain. It really is. I mean, you're doing
The whole-
a great
the whole
job with
mining
it, Jack.
thing, I
But
could
follow
never
it.
understand.
It's and you have Bitcoin miners like a Riot Platforms, for instance. You can buy Bitcoin in many different ways. I know a lot of people are interested in it. Like I said, it's gone up $20,000 in the last since the election. So it's more and more being spoken about. You can buy. You're not actually buying a physical coin, but you can buy it through an exchange traded. I'll call it a stock because it has a stock symbol. So you can buy it where you buy all of your other stocks through your investment account and do it through a stock symbol. One of them is BITO. I'm not telling anybody to.
DOGE.
I'm not giving any stock picks here, but it's just one example where you can buy Bitcoin that way. But again, can be very risky. Even the miners, Bitcoin itself, we've seen big ups and downs. Coinbase, that's another company that'll trade up and down $50 a day, sometimes more. So it's very risky. It's very volatile. But if you are interested in Bitcoin, there are ways to buy it through an exchange-traded vehicle.
I know that New York State has limited which cryptocurrencies you can purchase now.
Correct.
Because I used to buy Doge all the time, and I made a lot of money with Doge. And New York State no longer allows you to
Well, because
do
there's,
it here.
again, certain companies are more forthcoming in
Yeah.
what they're doing.
So I have a pretty funny anecdotal story with Doge. So we were getting ready. I had $11,000 worth of Doge money. I didn't pay 11, but whatever. So my wife Gina wanted to go on vacation. Said, I'll sell some of the Doge and we'll go on vacation with it. So I sold and we went on vacation. And by the time I got back from vacation, I looked at the stock and it had gone up from like the 8 cents that it was to 49 cents at the time. I'm like, holy crap, that was a $70,000 vacation, Gina. I was so freaking mad. I lost it. Well, I didn't lose anything because I made money on what I took out, but had it still been in there, it would have been at $70,000. And I'm like, oh, most expensive vacation.
Well, that's what you
I
get
ever
for
went
taking.
on.
That's what you get for taking time off.
Well, I think probably what you have to look at in the background of these guys who are doing this is you have to look and see what they're creating in their encrypted files.
The problem is there's no tangible goods with cryptocurrencies.
Exactly, but that's
Yeah.
my point is that if you're looking at this and you're looking at the algorithms that they're using, they use it's the SHA 256. It's hashtag. It's high-end encryption. If you can find out from the company what they're doing, because once they reach to a certain point and they get their algorithm and they hash in place and they create the next blockchain. That's usually when you start getting an explosion and these things start marketing, because that's when everybody's, okay, we got a new ad, now we have to start money again, we got to start adding, and that's usually when you get these swells. Now, the part of the reason for this jolt has been Trump has said that he'll start looking at this, and the Congress, apparently, there are more crypto-friendly representatives now in Congress than there has been. A lot of this stuff is offshore.
Mm-hmm.
Some of them want to bring it back onshore. You know, Plattsburgh was a big place for doing this. Okay, it moved. New York State, Texas, and Florida were the three big states at the time. we were spending all our energy going to these spots. Now they want to start bringing some of these things back in again. My personal opinion is, at some point within the next 3 to 5 years, it's going to be either rolled into the commodities, or some government entity is just going to take it over.
Yeah, because
Yeah.
the attractiveness right now is the fact
Yeah.
there's no
Right.
controlling entity over it. That's what's attractive to most people.
Yeah.
No, it'll be interesting to see where the future of that goes. And it's and we talk about the Trump trade, right? So before the election, if you thought Harris was going to win, you might buy certain investments, and if you thought Trump was going to win, you buy other types of investments.
Kashishi,
And
the Kashishi
yeah, I think
exchange.
so.
Boy, he's in big trouble right now.
Yep.
And some of the items in the Trump trade were Bitcoin, small caps, which are smaller companies. That was another item seen as benefiting from a Trump win, which has happened. Small caps have lagged the other segments of the market quite a bit over the last few years, but they've had a little bit of a surge here since the election. Bitcoin's way up since the election. The one that intrigues me the most is oil, because the price of oil has been somewhat elevated, but not terrible. But
what are
we're
we at
we're
right
looking at a time now with Trump coming in of deregulation, lower taxes, and the divide between where we would be if Harris was in on regulations and taxes versus Trump. I mean, the divide couldn't be wider. And as with everything else, it's all based on supply and demand. So you would expect with the Trump administration, there's going to be an increase in the production of oil and other energy assets. We also already see economic activity picking up. Mortgage applications are up. Well, the interest rates really haven't moved too much, went down a hair in a lot of places on
Probably
mortgages.
be a couple of years before they come down.
Yeah, but mortgage applications are up since the election. So I think you're going to see more economic activity. You're going to see an increasing a better economy, which means there'll be more resources used. So again, going back to supply and demand, if you have more supply, but you have more demand, and where does everything shake out? And that's one I'm watching closely.
Well, let's take your oil. If there's a Toyota as an example, Toyota has changed battery life. Okay, they have a battery that's they estimate up to 750 miles. Okay, before a recharge. Clearly, that beats any EV that's on the market today. It uses diodes. The problem that they have now is they have to figure out a way of making the diodes more stable, and they're a lot more stable than lithium batteries are, but making it more stable to be able to get it in the production line. So you're probably looking at 27 to 28 before that comes out. Once that happens, clearly that changes the EV market altogether.
Right.
But we can't assume that's going to happen. So how long does it take for the automobile industry to turn over vehicles? It takes about 20 years to turn over vehicles. So if it's going to take 20 years to turn over vehicles, we have more people driving, we have more people in this country, there are more people on the road, there are more cars on the road.
Right.
If anybody thinks in the next 20 years that there's going to be less of demand for petroleum, I don't know. They're whistling in the dark.
Right.
There's going to be at least the same demand and probably more because of these other entities. Certainly, like I said, one of the things that could change that would be the technology that Toyota's got on the books now that they claim is going to do this. But it's still going to be 15 to 20 years.
Yeah.
But a lot of problems with a lot of the EVs is if it wasn't for government subsidies, it would be unaffordable. And you take the government
correct.
subsidies out of
Well,
that.
that's true of all
you know.
green energy.
Correct. So you take the government subsidies out of it, suddenly nobody's buying electric cars because you can't
Well, they're not
afford
buying them anyway. So.
it. No, I agree. I'm just, windmills too, believe me.
Which is why the mandates are so foolish.
Correct, so
I mean,
foolish.
these EV
artificial.
mandates, hopefully, we'll start to see the end of them, although certain states, I'm sure, like New York and California, will continue to push them, but at least on a national basis, we'll get away from that.
Yeah, the only thing I could see on the horizon that would change anything from an energy standpoint is what this technology Toyota claims that they have.
So you basically see the trend of oil, the price of oil generally increasing. Generally, I mean, it's going to
Generally,
go up and
yeah.
down, but
But again,
You think oil's going to go up in price?
well, again, what will depend is what they're having a problem in the Middle East right now and agreeing to the cutbacks. Every one
Well-
of the countries are starting to pump, so that in itself will drive the prices down. Some people are saying oil can go back down to $40 a barrel. Okay.
Well, remember,
right now it's at 70.
OPEC does not want us to become energy independent. What's the only way they can do that is to lower the cost of oil. That's what's going to happen.
So the point is that we're going to be on the petrol train for a
while,
long,
sure.
long time. It's
Yeah.
going to be at least another generation or two.
It's just interesting to see where that price might go in the next few years with all of the things that affect the price of oil that we just talked about, how all that's going to shake out. As far as real estate goes, the real estate market hasn't had a lot of stock in inventory. A lot of people are at higher interest rates, or I should say, are at lower interest rates. Some 2, 3, 4% perhaps, and aren't in a position where they want to buy another house and take on a 6 or 7 or plus percent interest rate when they move. And that's really been a stagnating factor for the housing industry.
That it's interesting too because we in our market here we tend to be a little bit lower valuation than you would be in some of the other areas around the country, North Carolina, Florida, so forth. If you were to take our homes, generally speaking, depending on where you live, and move those to another area south of the Mason-Dixon line, it's probably a $250,000 difference.
Well, not only that, look at the taxes you're paying too. On the property tax makes a huge difference. I did a cost comparison with my son. We took a raised ranch locally and a raised ranch in Florence, South Carolina. Same cost was pretty close, comparable for the house, but the property tax is about $4,000 difference.
Yeah.
That's a huge.
Well, not the least of which is your state income tax too is different.
Sure.
That's
Sure.
for
Absolutely.
sure.
So, but the other side of that real estate is that's about 10 or 15 years ago. That was made another sector of the S&P 500.
Yeah.
Investing in real estate can produce some nice rate of returns. How would I do that? I would do it. They're done through a real estate investment trust, but I'd do it through a mutual fund of REITs. That way, most of these pay you on a monthly basis.
Yeah.
Most of the yields on these are 6-7%. Why is that? Well, because when you buy these kind of investments, by law, they have to pay out 90% of their net earnings to you and I as shareholders.
The IVR I'm talking about, that's exactly what it is.
So they have to pay out that money to us.
Yeah.
So
Right.
if you buy a diversity of product, meaning you bought commercial properties, single-family home properties, you buy apartment buildings, and you buy them diversified and across the country, there are going to be certain areas that are flat, certain areas not doing well, certain things that work well, shopping centers don't work well, but you're going to get yourself a steady cash flow and something like that.
And when you hear somebody talk about REITs, that's what they're talking about, real estate investment trusts. Yeah. And there's also other things called master limited partnerships, and those are generally energy companies, companies that own, for instance, pipelines. You can buy companies that own pipelines, and they have to pay out a certain percentage. Is it the same percentage? I don't know.
It's not as high, but you hit on something important. Owning the pipelines is better than owning the because it's going to flow through there forever.
Yeah.
I'd rather own the pipeline.
Yeah, and there's a lot of those companies out there. They have high dividend, high yields. They're generally, from a price standpoint, pretty stable. So you get a stable rate. It's not a stock that's going to go up $10 in a day, but it's pretty stable. They have a stable business because the stuff has to flow through their pipes, and they pay out high yields, high dividends. And I don't know if they're. I have a couple of them. I can't remember if they have to.
Well,
Push out.
they have to, but one of the problems, depending on how it's structured, is you get a partnership tax return. If you have it in
Yeah, I
a
know.
qualified plan, IRA or something like that, you don't really care. If you own it individually,
K1.
Yeah.
Yeah,
That's usually a pain in the
my
neck for
accountant
people.
curses me every year because typically you will get all of the information you need for your tax returns at least early in that tax year. And these K1s from these master limited partnerships, you might not get that till April.
And later.
Yeah. So it always drives him nuts. So,
The other
hopefully
side of that too is it may have a 10% return, of which 7% is returning your capital. So in theory, you're supposed to reduce your cost basis by 7%.
Right,
The accountant will do that.
Yeah.
So at some point in time, when you bought it at 10 and want to sell it at 15, you may have brought your cost basis down to 0. So now you're paying taxes on 15 as opposed to 5.
Yeah. Yep. So I guess the point is there's so many ways that if there's something, and a lot of times investing comes down to what you know. You know, what do you know? What do you deal with? Where do you shop? Again, go back to what I said earlier about intuition and gut and what you see on a daily basis. If there's something that you know that you feel strongly about, a product, a store, a particular type of business that you like to do business with, and you see them being successful and you enjoy doing business with them or you enjoy the product, you can buy that product. You can buy it in a basket of other stocks or you can buy it individually. So there's so many options that you have. But again, the key is to start small and just have a set time frame of when you're putting money in your account and buying securities.
If you are a young family, if you have a young family, why don't you find out from your kids what's the latest
Yes, yeah,
and who manufactures that?
that's right.
I can remember when my daughter was small, we did that, and I never heard of some of these companies before, but it's now called Gap.
Yeah,
But that was the latest, when they were in grammar school, they were just coming into the fore, and
yeah,
so you can, whatever you see, there's somebody had to manufacture it, or there's something around that has capital invested in it.
Amazon. Look at Amazon's a good example.
Oh, yeah.
I first started investing in Amazon when it was $30 a share.
wow.
Well, if you
That was
bought,
back in '96.
it's interesting. If you bought Amazon around $5 a share in 1999, that today is worth about $70,000.
Yeah,
If you had then waited a couple of years when the dot-com bubble happened and bought it at adjusted 33 cents a share, you'd have about $600,000 today.
I sold it too soon. Story of my
if
life.
only we knew.
Story of my life.
But again, you're here on the Phil Barrett Show. I'm here with Jay Thompson, who's just about to leave and call Goldman Sachs. He's going to get an IPO going. So if you want to be on the ground floor, call Jay. Get your money ready. And,
No, Phil.
And Jack O'Toole has been our special guest today. And Jack brings decades of experience to our discussion today on the financial matters affecting your life. So we hope you've enjoyed the show. Is there anything that you'd like to leave with, Jack? We're coming up here in an hour or so. And
I'm happy with the direction of our country. I think we're going to be highly successful over the next 4 years and beyond.
agreed.
Well said.
Well, thank you all for listening. Don't forget to subscribe, TGM. Go find us on YouTube, subscribe, and yep, there it is. And we'd love to have you as a subscriber. Jay reported to me today that we've been doing the Phil Barrett Show here for a few weeks. The amount of subscribers has gone up quite a bit over the last couple of weeks. So good momentum. Tell your friends about it. This will be a place that you'll want to go to on a regular basis for all kinds of information and just have a little fun, right, Jay?
Yeah, absolutely.
Yeah, man.
Yeah, man.
All right. Well, thank you all. Good luck and good luck investing. God bless.
We were great. We were free. Had a country that couldn't be beat. We were right